Royal Caribbean Cruises Limited, ticker symbol RCL, is currently trading at $246.28 a share. Over the last year, this stock has been on an absolute tear, up 115%. If we look at the chart of the last 5 years, pre-pandemic prices, it was $133, dropped 80%, and this stock has been a buy the entire time. It actually hit its pre-pandemic levels at about the start of 2014 and has then got up 92%. So what we're going to be doing today is looking at my automated stock valuation spreadsheet, seeing if Royal Caribbean is a buy using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So firstly, if we put in the ticker here, RCL, this will load up all the latest company financial data so we can have a deeper dive. If you're interested in this, please check my Patreon, but we'll talk about the actual stock first before we get into that. So as it loads, $246 a share, price $66.2 billion in market cap, a PE ratio of 20, well, just under 26, which is currently lower than the market average, which is around about 31. Earnings per share $9.48 and a beta of 2.59. So one of the more volatile stocks I have actually shown. I haven't seen it over 2 very often. And analysts saying it is about fairly valued at the minute with a target price of $236. So they do actually pay a dividend. It didn't get removed due to the pandemic, but 0.66%, meaning they'll pay you $1.63 for each share for every time for the year you own the stock. If you want to get the shares, buy before the 20th of December 2024 and you'll get paid your quarterly dividend. Now, in terms of net income, it is safe, yes, but in terms of free cash flow payout ratio, it is not. They have not had positive free cash flow consistently since 2019, and obviously we all know what happened then. But let's have a look at the numbers. Revenue, all-time highs, $15.14 billion. You can see they were consistently growing up until 2019. A little something happened in these 2 years. They were able to bring it back to $7.3 billion and then continued from strength to strength, 12 to 15. And if we have a look here, as a sort of general line here, you can see it's probably on what we'd expect if it didn't have this blip, which is why the stock was at such a discount. Net income, is it a similar story? And yes, it is. $2.6 billion of profit, and that is all-time highs once again. You can see here they were doing very well. Something happened and it took them a bit longer to become profitable again. They did in 23, and in the trailing 12 months they are up to $2.6 billion. Free cash flow, it is negative, but once again, if we look, to be fair, they were never really loaded in cash apart from 2017, and then -5, -4, -2 in these pandemic years. Did bring it back positive, but dropped down slightly in the trailing 12 months. Now, if we have a look at operating cash flow versus CapEx, you can see operating cash flow is increasing. Now, that is positive here. In the years where it was down, they had negative operating cash flow. It's now positive again. It's just the CapEx is much higher. Therefore, the free cash flow is lower. Shares outstanding, what are they doing? Well, they had an issuance of shares in 2020, but consistently they realistically have been buying down back their shares, but they have issued some slight more, and it's been flat the last few years, so that is good. So let's have a look at the discounted free cash flow model. This is a way of valuing a stock, looking at their future free cash flows and discounting them to today's value. So let's just quickly put in the averages here, although because of a certain thing that happened in 2020, I don't think it'll like this, but it also has low free cash flow rate, multiples anyway. Currently $4 a share, so that's not good. Let's have a look here. Yeah, revenue estimates were average estimating -155%. I don't think that's fair. Obviously, this is because of the big minus years in 2020 and 2021. So let's see what analysts are saying in terms of revenue. They're expecting around about 16.5 and 18 billion. Sales growth, you can see, yeah, quite good. And also they're expecting 23% of growth in the next year. I've completely forgotten both of those numbers, I think. I have 16.5 and 18 billion. Yep, okay, I did remember. So let me put in some moderate percentages, 4, 5, 6. We'll do 10%. That's quite close. And that already brings it up to a $70 stock, so that's a little bit closer. Net income margins, will take an average of these last 2 years, 15%, not -1,000. And that brought it to, I don't know why I dislike that so much. Let me just redo that. 15%, 16%. I suppose because there's a low free cash flow. So minus 99, unfortunately we're getting better. And so we all have negative free cash flow. So if we do go back to 2021 where they had about 3.12%, still puts it very, very undervalued or overvalued, sorry, in terms of discounted free cash flow model. So very interesting. Discounted free cash flow model hates this stock, but I suppose if we look back at the free cash flow historically, that isn't too much of a surprise because it's only ever been $1 billion, maybe 2 in the green. Right, let's have a look at the dividend discount model. Oh, and they stopped paying the dividend during those years and then actually reinstated this year. So that is bullish. They just need to keep on growing it. I misspoke earlier when I said they haven't. They do have the dividend now, but they stopped for those 3 years. So we want to see them keep on increasing it, and then we can use this again. Ben Graham formula for intrinsic value. This is a way of calculating the value of a stock created by the godfather of value investing himself, Ben Graham. Looks at earnings per share, PE of a non-growth company, AAA bond yield, corporate bond yield, and I believe we are still at 4.95%. Oh, it's increased. Jeez Louise. 5.14. That is, Ben Graham is going to hate all these stocks. So you can see there it brings the share price down by $10 off the rip straight away. But what do analysts say for growth? 23% over the next year. So let's see what that is. There you go. Interestingly, a buy. $269. Very nice. So a slight buy according to Ben Graham. Obviously, the Graham price, which is a margin of safety of about 20%. Well, a bit more than that. You can see it's not a buy, but Ben Graham is saying the stock is undervalued at the minute, and that is even with this high inflation. So if it was 5%, that brings it up 4%. It'll be $300. I mean, so it's just, well, what was it the other day? It was 4.59. That would have been $280 stock. But with a 5.4, 1.14, it's a bit more expensive. So finally, we'll have a look at the comparable company model. This is a way of, let me just bring this in a little bit because I have changed the sheet around. We want everything on the same page so we can read it. And then I'll continue with what I was just saying. Bring you in. There you go. So this is the comparable company model. This is a way of valuing companies, looking at similar companies of similar industries and sizes. And then we look at certain metrics here: EV to revenue, EV to EBITDA, PE, forward PE. But we're also going to look at revenue growth, EBITDA, net income, profit margins, things like that. So what are the obvious? Well, CCL, which is Carnival Cruise Lines, and NCLH, I believe that's the right ticker, which is Norwegian. So let's have a look at this. Enterprise value. Oh, I think Carnival Corp. Oh, wait a minute. No, I've done this before. This is what happens when you mess around with sheets. I should put them in here. CCL, Norwegian Cruise Lines. I shouldn't change that sheet. I need to make this because obviously it overwrites it. I didn't think Carnival had a $1.3 trillion market cap. That looks more like it. So, enterprise value, Royal Caribbean is the biggest, 81 billion compared to Carnival and Norwegian, 1622. Interestingly, second highest revenue, lowest revenue growth rate as well. EBITDA, second highest. Net income, most profitable. Highest profit margins, 18%. Price to sales, the market average is 3, so it is over that with 4.3. Both of these are under it. Price to book, the market average is, I believe, 5. Yep. So over it again. PEG, which is Peter Lynch's price to earnings growth. You want to have this under 1. Norwegian and RCL, Royal Caribbean, or Caribbean, sorry. I'm saying it the English way, not the American way. Royal Caribbean, I should have been saying the entire way, but I've said it both ways anyway. 0.66, 0.33, so undervalued by his metrics. EV to revenue, highest number. EV to EBITDA, highest. PE, second lowest. And forward PE, second lowest. So not actually a buy according to these. It looks a little bit overvalued if we were to compare it to Carnival and Norwegian. So quite interesting. But just as a final thing, if we were to compare it to CCL and Norwegian Cruise Lines, and if we do the 5-year chart, yeah, this stock is up post-pandemic, whereas those two are down. Over the last year, they're all had a bullish thing. So maybe Royal Caribbean has not got that much to run up. Maybe this is the peak, as it is at massively all-time highs. But is this the right time to get in on Carnival and Norwegian? Who's to say? But yeah, I've always been interested in the cruise liners. I was buying them back in here and here, had to sell out of a few, but then obviously now finally we're starting to see the profits. Now we want to see those in Carnival Norwegian as well. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon. You can help me out with $1.50. You can buy the sheet for $4. You can also review and get the reviews as well. But yeah, I would say the $4 one is the most value. But if you want to just give me some money to help me out, that is great as well. Right, guys, I'll catch you next time.